I think how you talk to customers versus how you talk to investors are two different ways to tell the same story. And a lot of times it feels like these founders are just yelling to investors rather than saying how great their product is.
It's basically thirst traps for investors is basically what they're doing.
Yeah.
The fact that the cost of creating things has effectively gone to zero means that judgment and authenticity, these are going to be like the residual pieces of marketing.
So there's a Silicon Valley joke that the average CMO tenure is the shortest in the C-suite. It's about 18 months.
I think that's actually accurate.
Is it?
It is a lot easier to change your logo than change your reality. If you're trying to tell the world, oh, we're blah, but now with AI, it's a lot easier to like redesign your logo, put some sparkles around it and update your homepage to say AI first, blah, 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 than it is to actually go and be an AI native company.
From Mostly Media, it's Mostly Growth. Go-to-market strategist Kyle Poyar and CFO CJ Gustafson share smart takes on growing revenue and running a company. Pricing, unit economics, AI, leadership, candid insights for CEOs, CFOs, and CROs, or anyone else aspiring to climb to the C-suite. This is Mostly Growth.
Hey, thanks for listening. We'll be right back after a word from our sponsors. You just launched a new AI product. The new pricing page looks great. I'm talking crisp. But behind it, last-minute glued code, messy spreadsheets, and running ad hoc queries to figure out what to bill. Customers get invoices they can't understand. Engineers are chasing billing bugs. Finance can't close the books. Well, with Metronome, you hand it all off to the real-time billing infrastructure that just works. Reliable, flexible, and built to grow with you. They turn raw usage events into accurate invoices, give customers bills they actually understand, and keep every team in sync in real time. Whether you're launching usage-based pricing, managing enterprise contracts, or rolling out new AI services, Metronome does the heavy lifting so you can focus on your product, not your billing. That's why some of the fastest growing companies in the world like OpenAI and Anthropic run their billing on Metronome. Visit metronome.com to learn more. That's metronome.com. As a CFO, you're expected to bring clarity to everything, including how your company manages ownership. The tools you use should make that easier, not harder. But when they come with hidden fees, data you can't always trust, and support you can't rely on, you end up with more frustration than clarity. That's where Pulley comes in. Pulley is a cap table management platform built for finance leaders who need accurate, decision-ready data from a system that works for your business, not against it. With Pulley, you get intuitive workflows, audit-ready reporting, and support you can count on, all backed by predictable pricing you can plan around, so you can stay compliant and make smarter decisions about your company's future. Manage everything from fundraise modeling to ASC 718 reporting to custom liquidity programs, all on one trusted platform. Hundreds of high-growth companies like Linear, Fathom, and Runway trust Pulley to help turn ownership into a strategic advantage. And joining them is now easier than ever. You can switch to Pulley in as little as 5 days. And for a limited time, they're offering 25% off your first year. To claim your exclusive offer, visit pulley.com/mostlymetrics. That is PULLEY.com/mostlymetrics. Please, guys, I really need this. Pulley.com/mostlymetrics.
Welcome back to another episode of Mostly Growth, the mostly serious podcast for anyone who cares about startup growth. Joining us today is Des Traynor, the co-founder of Intercom, the AI-first customer service company. And Des, if I'm not mistaken, you co-founded Intercom more than 14 years ago. Is that right?
It is. Yeah, it makes me feel old, but that is true.
I looked back in 2011, the big tech stories were Google trying to build a social network. That was Google+. Netflix splitting off its DVD and streaming businesses and seeing its stock tank as a result, and tech IPOs from LinkedIn, Pandora, Groupon, and Zynga. I'm curious, what are you nostalgic about when you think about those early days of building software?
I really liked Foursquare, the early days of Twitter. I don't know if you remember before there was Twitter, there was things like Bourbon, I think at one point. It was a whole heap of like cool social apps, like SlideShare was a thing. You used to go to SlideShare most days and find cool presentations and stuff. Yeah, I think there was an authentic naivety to the early days of tech where Twitter was like mostly, your own crew, and it was mostly web people basically. And all of the sites felt like they were kind of built for us. Even early Instagram felt so different to what modern Instagram turned out to be. So I think I'm nostalgic for all of that. And then obviously this was the sort of heyday of the explosion of what you'd call SaaS, right? So Basecamp, etc., all kind of landed in this period and to great success. It felt like every few days you go to Hacker News and you'd find some incredible new fancy application of what we called Ajax at the time. There would be a really cool way to do some sort of effect. And even you mentioned like Google Plus, like even Google Plus first launch where they had all these like virtual circles that you could define your friend groups and all that. It was very cool what they were trying to do. Obviously it didn't work out, but but the effort was really noble.
Yeah, I do have to say, I don't miss Groupon. I think I started buying things on Groupon and then it just went so downhill so quickly. But amazing that was like one of the tech successes back then. I was reflecting on, in the last 15 years, like tech's gone through so many changes. And one thing I was thinking about was like what's gotten harder since then. And a co-founder of Ramp actually just put out a LinkedIn post saying, today marks the day we shut down outbound automation at Ramp. This is the AI SDR program they built in 2021. 5 years ago, I remember interviewing people from Ramp, and this was like a trade secret. Like they saw this as core to what made them unique and hyper-growth company. And now they're saying, hey, that the space has gotten so commoditized, it's hard to do. Did you see this from Ramp?
Yeah, I saw it from Ramp, but the whole pattern deeply resonates. I just think most things have gotten easier, except for getting attention. Every channel that we would have used back in the day, whether it was like Twitter or Hacker News or Product Hunter, they all just turned into marketing channels, like hackable, gamified marketing channels. And all of a sudden you have people saying, hey, for $5,000, I'll help you with your product hunt strategy and all that. Like every single angle of attack that was ever there has been exploited and battered. As such, I invest in a lot of startups. So one of the hard things I just see is like people with great products who just are like, literally, dude, how do I get anyone to look at this? And even I can go and message people and be like, you should look at this. And they're like, yeah, I don't have the time to look at it. And it's just, I feel like there are potentially too many, great, well-executed startups ideas chasing too many sort of disparate audiences. And it's just getting really, really tough. And I think the best approach these days is probably to go quite niche. Like, if you want to sell a product to finance teams, go after the CFO newsletter. Don't go after like just mass market tech anymore. Like there's an approach for everything, but it's just, you have to be willing to say, hey, I'm going to go after a smaller crowd with a clearer message and kind of just work my way up like that. The idea of like a B2B SaaS product just going viral the way we would have back in the day, it's just gone now.
CJ likes that advice on the CFO newsletter. I guess, is there anything on like the positive side? Is there anything that you would say is easier from a distribution standpoint or that's like unlocked now that wasn't possible 10 years ago?
Not that works, in my opinion. What we find is our marketing efforts shift a lot these days to IRL events, dinners, meetups, and anything where like you can't fake it, basically. I find every legitimate channel has been kind of growth hacked to shit. And so as a result, we find ourselves looking for things that like our efforts are obviously authentic and aren't kind of hackable or whatever. Even if I write a blog post these days, and I don't use AI to write blog posts at all, but I still get people being like, oh, that was cool. You must have really good AI, do you? And I'm like, no, I just wrote the damn thing. So I genuinely don't know if there's much easier. I think just everything is more competitive is one thing. Like in 2011, it wasn't obvious how big these companies could get and how much money was at stake. So I think there was less people chasing the prize. There was less, as I said, hacked up or gamified channels. And then there was like no AI to like further dilute and pollute. Go to market is going to be a hard grind for this era. I would have always said best product wins, but I'm not even sure that's true these days.
Des, there's a big emphasis now on AI founders, posting on LinkedIn, making their face known to people. And people are saying, oh, well, founder-led sales are back. I feel like founder-led sales are how all companies kind of start. Do you think it's changed with the position of the founder being a channel for sales? Has it always been like that?
At the early stages of any company, founder-led sales is really the only sales that matters. We did founder-led sales back in 2011. It just didn't have anything that was called like grinding or trying to win a customer. Like I think the reason we think that is because there are so many new AI startups. And then if we're honest, there are so many non-AI startups that have repivoted and rebranded themselves as a recently founded AI startup. They're all trying to like reintroduce themselves to the internet via like lengthy LinkedIn thought pieces. And I think that starts to look like founder-led sales. But I just think like if you're in the early days, you don't really have any big marketing machine. You're not going to run a successful like ad campaign or YouTube pre-roll. Like the thing you have to do is say the thing your product does, offer up some evidence as to why people should believe it does it. Ideally present all of that in front of people who should buy it. Put your stuff out there, see what bites is the kind of the general approach. And I think we have seen the kind of Cambrian explosion of startups in this AI era, startups and also like Rebrands or whatever. So there's a lot of people trying it. The one downside of that I think is like, I do find there's a lot of founders who they're more quick to tell you, look how much money we've raised and look how much revenue we've got and look how many people we've hired and look how many offices we've opened than they are to say, our customers love our product. Here's why. Never ask an AI founder what their margin is if their product works, or or perhaps maybe how many of their customers are happy with the decision. I don't know what product market fit looks like in this era, but I'd rather have a lot of customers finding a lot of value than have a few enterprise deals right now, because I just don't know how that plays out over time.
Because I think how you talk to customers versus how you talk to investors are two different ways to tell the same story. And a lot of times it feels like these founders are just yelling to investors rather than saying how great their product is.
It's basically thirst traps for investors is basically what they do.
Yeah.
There's a pattern I observe with startups in general, which is like the great startups have this attitude of, if reality isn't good, let's fix reality. If it's just the narrative around our company that's not good, let's fix the narrative. And I think weaker startups say, if people think our startup is shit, before we even worry about that, let's fix the narrative. And I'm like, I don't know. I think step one there is work out, is your startup actually good? And you see this, by the way, in all like the public SaaS companies who are like, the concern is that the public markets don't realize that we have successfully pivoted to AI. So rather than going and doing the pivot to AI and actually building some good AI products, what they instead do is prioritize talking about AI a lot. And I'm like, that's cool. But when I click log in, I'm still looking at the same product from 2017. That's the actual problem. The reason people think you're stuck in the past is because your product is still stuck in the past. It's not because you're like lacking in a few dope tweets about like margins or whatever, you know. So there's a weird anti-pattern there that I see a lot of folks go for, which is just, in photography, they say if the scenes are broken, you fix the scene. And if the lens is broken, fix the lens, but don't get them confused. And there's a version of that for for startups, I think.
Wanted to go into this point a little bit further. So I actually just did some research with ChartMogul, which has data from several thousand customers, including SaaS companies and AI native companies. And we looked at annualized net revenue retention and gross revenue retention across the companies that are B2B SaaS versus B2C SaaS versus AI native. AI native companies, the retention rates were significantly worse than B2B SaaS, especially on the low deal size companies. So the AI native companies selling for under $50 a month had 23% median gross revenue retention and 32% median net revenue retention, more than 20 points worse than B2B SaaS. Are you seeing similar things, or are you seeing kind of things differently?
Well, if you mean us in terms of Intercom, definitely we're really happy with our Aurora and our Giro. Our product works really well. The average customer gets insane value from Finn. Our renewal rate's really, really positive. Churn is comically low. Like the churn Finn, you're going to be like, oh, well, I guess I'm going to go and hire 100 support people. Like, you're not going to do it. It's like Finn works really well. But nothing here surprises me. This in-wrapper comment is definitely there. But I think like on the high end, many products in AI sound awesome. The problem is there might not yet be totally possible. So if I said, hey, I've invented a tool that optimizes every single advert your company publishes and will like double your LTV CAC overnight or whatever. That sounds incredible. Everyone's going to try and buy that product. So as a result, you will kind of have this initial pop of like sales. And then when people realize it doesn't work, you can probably drag them along for like 2 or 3 or 4 months by saying, you're holding it wrong, like to quote Steve Jobs, if you know what I mean, like, oh, you're not doing the right stuff in the right way. Look, reality bats last in software. So you can have all your talk and all your words and all your excuses, but at the end of the day, if your product doesn't work, it doesn't work. And I do think AI is perhaps plagued by a lot of hype and ideas that aren't yet working brilliantly. And separate to that, this kind of era of hyper competition we're in encourages everyone to lie even more. We have always taken the approach of being really honest about Finn's resolution rate. There are others who'll be like, no, we do 99% resolution rate. And we say, well, we do 67, I think is our current resolution rate. Lying works in the extremely short term, and it's extremely detrimental to your relationship, be that with a customer or a partner or whatever, in the medium and long term. So what that shows up like is like weaker GRR or weaker NRR for that matter. This is a long way of saying a lot of this stuff has to shake out in AI. We're going to find out soon what products are genuinely delivering real value that people will continue to pay for and potentially expand year over year. The AI native products that have been through a couple of years of renewal cycles, they'll start to stand out because their revenue will still be strong. I don't know if you're familiar with Mamoon Hamid's quick ratio, where he contrasts churn with like future growth. One of the points he uses this for is to just say, it's easy to burn through a forest, right? At any given point, you'll look like you're on fire as a business. Like, as in, if everyone quits after like 5 months, you tweak your reporting chart a certain way. At most points, as you're burning through the market, you'll look like you've got a stellar business. It's even better if you do annual contracts and if you do cash up front. And if you layer all this shit in, you start to look like you're on a serious heater. Only when you actually look at the churn, this is the reality backs last, you actually realize, hey, this thing actually does have explosive growth. And it is explosive growth and a phenomenal amount of ticking churn bombs that are going to come home to roost. And that market will eventually tap out. And this churn won't. This churn will be endemic or whatever. So I do think like the early days of SaaS was a bit like this. There was a lot of like this, this product's going to do so much for you. And if people realize it didn't do all that or whatever, I just think we have that and then some right now.
I have to admit that a lot of the products I've tried, at least personally, I've probably burned through 5 to 10 AI apps. They've been remarkably easy to unsubscribe and churn from. So some of it, Kyle, too, may just be the construct of more traditional B2B SaaS. You just can't get out of a contract that easily. Part of the reason why I even tried them was because I thought, and it was true, that I could get rid of the product if I didn't like it. Like, there was one product that was for making slides, and they promised me the world on, you just literally type in what you want and we'll pump out slides. And it was remarkably
AI
terrible.
native PowerPoint. Yep.
It was so bad. The slides were horrible. But to their credit, I only burnt 1 month. They didn't charge me anymore.
Yeah, and if there's an increasing number of views, that still looks like a business that's growing. I think the other thing that's perhaps working against some of these early stage AI startups, even if you just take like the cool ones that are definitely working, like say Cursor or any of those, we've yet to get to like the multiplayer AI stuff, and we've yet to get to like the stateful AI stuff. So like, does it matter if all of your team use a different coding agent? Not yet really, but it will, right? And like, doesn't matter, like, if let's just say in your slides example or a docs example or any of those, let's say the 4 of us are a startup and we all use a different product. If that's a problem, then all of a sudden there's a desire for convergence, and then the convergence becomes a desire for retention, right? So that's one thing. And then state is another piece as well, which is like, historically you'd say, oh, we can't move everything out of our CRM and import it all into something else. I think like in a lot of these product areas, you actually kind of can. You can just jump from one to the other and you're not leaving too much hard work behind. As the years clock by, people will figure this out and realize, hey, we should design for like, I tweeted a while ago saying like, who's building like a multiplayer vibe coding environment? Wouldn't that be cool where you could like have GitHub style vibe coding where I can suggest a branch and people can accept it and all that? And like whoever does that, all of a sudden it'll really matter and we're going to want to converge on the same vibe coding environment, right? And those types of things will happen soon, but they just haven't, in my opinion, fully kicked in yet.
My guess is that's Figma's hope, is that they can be the late adopter, but that has the context, they have the design, they have the multiplayer sort of use. I know you've been talking and writing about this a lot, but you have a framework that all great AI companies have real usage, real business impact, deep and differentiated AI, and strong margins. So who do you look at as like examples of these great AI companies?
So I don't always see the margins. I'm like, as I said earlier, never ask an AI company their margins. We're pretty damn happy with ours. An AI company, I think, has adapted extremely well. Like on the high end, I'll say like Gong, right? Like who would have seen this one coming in some sense, right? Like, but like Gong's AI is extremely powerful to me as somebody who's not a proper like Gong user, nor am I a Salesforce user really. But to be able to review any single situation with any of our accounts and get a full summary that's pretty damn accurate is extremely impressive and extremely valuable. And like, there was a blip a while ago. I don't know if we forgot to renew it or something like that. But what it was missing, I felt like I'd lost like a fifth of my capabilities as it relates to like finding out what's going on in accounts. And then another example from I dare say low end, but let's just say a new startup is Granola, right? So Granola, like, they seem to be able to deliver extremely differentiated meeting summaries, action detection, shared recipes, all that sort of stuff in a way that no one else in the meeting summarization space has. It's a real business value in that like we have not yet gone wall to wall with Granola in Intercom. It's probably the most frequent Slack I get is some version of Des, can you get us on Granola? I just think that they've really Like they've gone extremely hard on what seems like a small problem, but it is a small problem with legs. It can be like detect follow-ups from this meeting, automatically inject them into everyone's to-do lists, schedule the following meeting, blah, blah, no conversation left behind type thing. So I think like there are some great AI companies that have just nailed the problem, real business impact, real differentiated, and like the usage is undeniable. So yeah, that's a couple.
So Granola, it's AI note-taking app. There's probably 100 companies that say they do AI note-taking. And so if you land on the website and it's like the best AI note-taker, well, this sounds like every other product out there. Like if you're Granola, how do you try to position in such a competitive environment when the messaging might sound the same as everyone else, even though the experience of the product is actually different and, uniquely better?
It's even worse. Like it's the messaging, and then arguably it's often the UI is the same as well. Like everyone's UI in the AI era is just a text box with a sparkle and it's saying, try something, The fact that the cost of creating things has effectively gone to zero means that judgment and authenticity meaning like, to what degree can I actually believe what you say? Is your marketing BS or not? These are going to be like the residual pieces of marketing. Like, so in the case of like most companies, what we're looking for, like, well, if we got to buy, say, like an AI dev tool or an AI, whatever, like go-to-market tool, the thing I look for personally is credible at scale deployments with like real business impact. And then I want to talk to people who use the product. And I want to talk to lots of people, not just the 2 names on the website who happen to share a board member or whatever, but actual real people who didn't know about this company before, found it, deployed it, and got successful. Because I think a lot of AI companies, through like the founder-led sales and the investor-led go-to-market that's so popular these days, what they do is they kind of like, you have VCs kind of bullying startups into adopting portfolio tech. And as a result, everyone's kind of referring everyone for everything. And it's all kind of nonsense. It's kind of like similar to in the late stage SaaS, we just had that like row of logos where like seemingly Google was a customer of every internet company in the world or whatever, right? The AI version of that is pretty similar. So look, the thing that actually matters is, are you known to be great by people in the right communities? So in the case of, say, the CFO newsletter, like Pigment either is or isn't a really popular product in that space. So if somebody asks on that newsletter, he goes to one of your meetups, asks on the Slack channel or the thread or the group chat or however it is you make the community a community, people will say, hey, I'm looking to do some AI first FP&A dashboards. The names that come back are the thing. Like, I mean, this morning I was on LinkedIn and someone was like, hey, thinking about switching off Zendesk, blah, blah, blah. And like, it's just an interesting pulse because this person was throwing out any intention. It was just like, hey, thinking out loud. But like the other players were all there in various proportion. But I think that's the thing that actually matters. So you could have 50 more guests on this podcast and you can ask each of them, what do they use for AI note-taking? And I would posit a lot of them are either going to say granola or they're thinking about granola, or if they've heard of granola and they'd like to use it or whatever. And it will be the same for like a lot of the other popular AI products. So this is a long way of saying happy, satisfied customers who are like confident to speak to the value of your product. What might actually be the only marketing that's left, or at least in this period where we can slop anything and we're in a post-truth era where everyone just lies about everything anyway. The actual thing that really matters is, will your customers speak for you? And if they will, you're probably going to win.
I don't know if you knew this, but the leading cause of death in CMOs is CFOs. As a CFO who's getting his mind around to the perils of cutting program spend, particularly brand spend, and what that can do to kind of your future pipeline and the network effect that just your company has, I wanted to ask you a couple questions about how you thought about marketing when you started Intercom out. In particular, when did you say we're at a scale now where we're going to start to put some money behind brand spend?
Oh gosh, that's going back a bit. Like I think the first 2 or 3 years we were heavy on actually like distinct punchy brand visuals. So like Owen as our CEO would have led a lot of the aesthetic presence. The brand of Intercom was like very distinct. The product itself was kind of semi-viral. Like you see it everywhere and people were like, damn, what the hell is this thing? That was really clever the way you started the conversation with me or whatever. So content marketing was back then a very successful channel. I think it's faded away because of slop. And because of being like an over-tapped channel. Basically, the Intercom blog was and still is a very popular blog, as is kind of now we have 2 other blogs and they're all kind of popular in different ways or in different circles. I think the first time we actually went properly into like big brand spend, as in thinking about like anything from like YouTube pre-roll to display network advertising all the way over to like billboards. But it was probably downstream of hiring like a real marketing leader who said, well, we're going to have brand and demand and content and community and like the classic CMO thing and whatever. Some of my best friends are CMOs. That's a total lie. They're not. If the classic CMO thing to do is basically they have the org chart in their head and like, I want to, if you bring in a CMO, they're like almost like a reflux. They'll be like, well, we need a VP of brand, VP of demand, VP of content, VP of product marketing. Before you know, you've got a big beefy org chart. Marketer is going to market. So like the VP of brand will eventually start saying, we need to get some billboards going and some like, how about a Super Bowl ad or whatever. I want to say like Series C or something like that was probably where it started. But I think these days we do a lot of it, but we do it a lot more intentionality to try and grow Fin and kind of awareness around the Fin identity.
So there's a Silicon Valley joke that the average CMO tenure is the shortest in the C-suite. It's about 18 months.
I think that's actually accurate.
Is it?
Yeah, I mean, like my friend of mine who works at a very, very popular company, he says like in Harry Potter, there's this position called the Teacher of Defenses Against the Dark Arts that you're not allowed to hold for more than a year. And we often joke that that's the CMO position. Like for what it's worth, I think that first sentence, I actually think that came out of a study or something like that. It's like, it is a joke, but it's also true,
Well, that's about how long it takes to update the company color scheme, overhaul the logo, and run a big expensive conference that doesn't turn into any pipeline. And so we've joked about this in the show before, but it's kind of funny if you look at these logos for HBO over the years. When I stare at it, Des, I see 5 different CMOs.
Yeah, I think that's about accurate. And you also see lots of inversions, right? Like the old guy had it right, now the new guy has it right or whatever. Remember I said earlier about this idea of like solving the narrative around the brand versus solving the brand. It sounds shocking because changing your logo is not easy, right? But it is a lot easier to change your logo than change your reality. If you're trying to tell the world, oh, we're blah, but now with AI, it's a lot easier to like redesign your logo, put some sparkles around it and update your homepage to say AI first, blah, 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 than it is to actually go and be an AI native company, hire an AI lab, start post-training models on AI, getting really good at like, evals. No one likes to do all that. So like, I think people turn to the optics because the reality is much harder and much slower to change.
Well, so one of the big things it sounds like you're betting on is you have happy customers. Let's get the word out about these happy customers that are using Fin in production. I guess, how do you think about like turning that into a program or productizing that so that it can become a real growth channel for you versus just, happening organically on a one-off basis?
I'll answer the question directly, but let me just say as a precursor to it, when you have something that's working, sometimes one of the worst things you can do is try and turn the dial on it. If you ever read somebody who had like let's just say a good or popular blog, and then they're like, oh, that blog's working. Let's hire 10 more writers and publish all the time. The quality of insights gleaned from each blog post will generally degrade. Like there's just a general pattern in marketing that people will expand every marketing channel until it starts spitting out crap, basically. But no one ever realizes that, like, because all else being equal, the extra blog post might have got you 4 more visits at the silent cost of your brand getting degraded. And people never know how to do that calculus. They have all the beautiful metrics and data points around what the incremental thing did, but no one ever bothers polling for like, but have we lost the hearts and minds of the people?
The extra Black Friday email results in revenue, but then you have an email going out every 30 minutes.
Exactly. And then people think, well, you might count your unsubscribes, but what you're not counting is the amount of people saying, yeah, I don't read their shit anymore. I just archive it on site. In general, people don't pay enough attention to like the sort of the harder to quantify qualitative stuff. Like, do people actually care what you say anymore? That's my kind of precursor. But that said, right, so lots of happy customers for Fin. What can we do about that? Our approach is every support team over the next year, 2 years is going to move to an AI world where they're going to use AI as much as they can to solve the highest volume of their queries as possible. That's just kind of a given, or at least it's a stated belief, but I think it's proving out to be true. So what can we do given that we've got a load of happy customers? What we do is we run these events. So one of them is called Blueprint, where we give you a blueprint for AI transformation. Basically, we're all over Europe, all over North America. We'll literally show up places and we'll say, hey, you want to move to AI. This is not a Fin pitching event. Fin is the team bringing you this, but we're not going to talk to you about things that are uniquely Fin here. We're going to talk to you about AI transformation, what it means for your team, the new roles you'll have to hire, what it means for your support experience, how you should change your metrics, how you should understand your new world, how do you think about costs, how do you talk to your CFO. All of those conversations have to be had because basically support leaders are a little bit lost right now. They know that they need to make a change, but it's not obvious what change can they make. So what we try and do is we say, well, let's bring all of our customers in, say, Sydney or Berlin or Amsterdam or London together, along with a load of like what we would call prospects, but it's really just anyone who does support. They can be using Zendesk or Service Cloud or whatever it is they want. And we'll just talk about the idea of AI transformation. And somewhere in the room, there'll be a little booth that's pitching Finn and showing you what Finn does. But that's not the actual reason you come. That's almost the sort of subtle, like, and if you enjoyed this, you're going to love that thing too. And that's one way where we put like successful, happy customers in a room with people who are considering and starting their AI journey. And we know that like just like through like osmosis almost, they'll all walk out with like a positive appreciation or affinity for the Finn brand. So that when somebody says, hey, it's time to get on the AI support train, we're at least going to be in the mix. And so that's the type of thing we do, which is like deliver value to the prospect and put them in an environment where it's almost certain that Finn will come out in a pretty positive light.
We wanted to switch gears and talk a little bit about pricing. Now, you guys are one of the first to launch, or if not the first in the AI space to launch an outcome-based pricing model. Want to get into that a little bit, but first, I wanted to kind of raise something that I've been noticing lately, and it's kind of this shift away from outcome-based pricing. PostHog just launched their AI pricing. It's an AI credit model. Everyone gets, 1,000 AI credits, which is $10 a token cost, but then they essentially just pass through their underlying LLM provider's costs, and they charge a 20% markup over it. So they're pretty much saying like, we're gonna not even attempt to do value-based pricing. It's literally cost plus, and it's like cost plus a pretty small margin. And I'm almost like seeing the pendulum shift like from outcome-based back to like a cost-based pricing model. Curious about like how you react to that.
The team at PostHog, I've never met them. I'd love to, but like I am in general impressed with their originality, their creativity. They poke bears, they push, they do interesting stuff. Even their homepage that you're on here is like really just, it's unique. There are times when it's really, really difficult to work out what it is you actually charge for. Let's say somebody uses Finn to, reroute an order. That's a complex Finn procedure that would like involving validation, order tracking, order lookup, order injection, like changing the order, etc. And let's say they change their mind halfway through and decide they want to talk to a human. In that scenario, and under our pricing, we get 0 cent, like $0, 0 cent. We did not earn anything for that, even though we did a phenomenal amount of work to advance the customer's understanding in real time of what's going on and connect them to a human in real time too. So like we did a lot of work and our payoff is 0. There are frustrations with outcome-based pricing in that at some point you have to draw a line and say this was an outcome, and everything short of that you get 0 for, right? We can answer 5 questions from a user in a row, but if the 6th question in the same conversation is a handy human, that's 0 for us, right? So they're all the limitations or the reasons why you should be wary of just YOLOing in outcome-based pricing. The challenge with PostHog's model is I would posit AI will over time become a huge part of their revenue. And I don't know if that's fully true. I know that there are also infrastructural software that does tracking, event handling, users, and all that sort of stuff, right? So maybe in their sort of future vision, AI is kind of capped or gated to being always a smaller piece of the pie. But if it's not, what does their business look like, and how will investors respond to a business that's increasingly 20% margin? That's not the SaaS formula. Like, I'm getting into CJ's territory here, right? Like CJ, for your take, if what does the world look like if SaaS businesses or like software businesses now tend towards 20% margin? Like it's a different setup, right? Like different multiples, yada, 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 right?
I liken it to how SaaS companies before traditionally had big arms but skinny legs. So they had high gross margin. It was like the guy at the gym who skips leg day. But now it's the inverse, where they have really skinny arms because they're using up all the cost in gross margin, but then they don't have as many employees. I think like with a company like PostHog, you risk having to make it up in volume, right? Like, yes, we are 20% positive, but you gotta sell a lot of stuff in order to make that 20% work for you.
But even at like the naive, like say like 20x, 30x multiple for like, let's say they're growing X 100% and all that, like it might confuse investors at best. If you're out there running a multi-$100 million SaaS business thinking, sweet, let's just charge a 20% markup on our tokens cost, I would advise you that like, don't do that thinking it's disconnected to the valuation of your company and how people appraise your company, et cetera, right? There is a big, big formula that connects all of these things, and you can't just yank one of them from like what has historically been 75, 80 down to 20 and think that nothing else will change. Something will pop somewhere.
You just become CDW instead of reselling hardware. You're reselling AI compute.
In general, I actually love the direction they're pushing. I just think there might be like more stuff to be figured out before you can adopt that.
Hey, Des, I'm getting to hang out with all the cool Intercom peeps. I actually just interviewed Dan Griggs, your CFO, on my podcast, Run the Numbers, last Thursday. And something that we were talking about was the pricing model around Finn and and how it's essentially 99 cents per ticket of resolution. But what I threw back at him, and I'm curious what your reaction is here. When I was CFO at a company that had a marketplace, it cost us like $30 on average to resolve a support ticket. And I was like, damn, Dan, you're leaving like a lot of value on the table. Like, how do you determine we're going to do 99 cents? Like, does it keep you up at night that maybe you could be charging 10?
You have to leave something on the table. You can either leave complexity on the table or you can leave some money on the table. The complexity in this case would come from not all answers are equal. Let's just say a 20-way back and forth regarding changing the name on a utility bill that involves looking up 3 different things, 2 authentications, and then at the end of it all, the person has 4 more questions. We probably, I'm going to guess, we might actually lose money on that with the 99 cent. And then the flip side, how do I reset my password? We might be able to spit that out for far less than that. And so the options are like, what do? Do you like chop up your query types and say like, hey, well, so when someone says, hey, how do you charge for film? Well, there's actually 7 ways. Or do you mark up the tokens a la post hog? Or do you just say, hey, we just charge you for your conversations? Some of our competitors do that where they just charge a lower fee, but they monetize all of your conversations regardless of how many they actually positively impact. It is a complex and messy beast, but you're always leaving something on the table. And the question is, what do you want to leave on the table? At the time, when we were charging, when we decided to charge 99 cents, believe it or not, we still get pushback that that's way too much. Resolving, say, how do I reset my password through a Philippines call center can actually be substantially less than 99 cents to the point that we seem dear. Now, oftentimes when people say that, we ask them to look at their full contract and factor in the seats and everything else that is going into it. And all of a sudden, it goes from their perceived 35 cents to being something more like $1.09 or something like that. There is a class of queries and there's a type of outsourced BPO operations that can bring this like all the way down. We sell there too. So it's just a messy one to be in like B2C and B2B, and B2C tends to have like the Pareto thing of like a large number of quite similar conversations. B2B tends to be long tail, messy, complex, and more expensive to solve. We're currently saying like one flat rate across all of that as long as we solve it. It is imperfect. Everything is imperfect. But what we were shooting for was like explainable, digestible, and should work in most parts of the market. I think we've hit all of that, but I can't say it's like future proof and will work forever.
Because me and Kyle debate all the time, theoretical thought experiment here. If I save a customer $500,000, how much should I keep? Should I keep 250? Should I keep 100,000? There's so many things that go into that.
There are businesses, and like Lord knows, we've made our mistakes in pricing in the past as well. Certainly, if you say, hey, we saved our customers $500,000, right? There's a class of thinking that would say, so we should charge at least $450, $475, right? The silent cost there is your customers don't really like you. They're like, yeah, that thing works. When you charge substantially less, it's like, dude, this is a no-brainer. People jump on podcasts like this and they're like, well, first things first, let's get that thing installed. There's value to bringing a no-brainer. There's positive market value. There's customer love. And if you find the exact bite point where like, the exact like whatever on the Laffer curve of like price versus demand, if you literally optimize that to the nth degree, what you might find is, yes, the pricing looks good, but you might have silently lost some love. You might have also invited a load of RFPs that you might still win. We've invited them now, and all of a sudden an RFP means now people are talking to 3 people, and that's 2 people who are going to be pinging them every year, renewal time and all that. So you have to think about that holistically as opposed to just being a pricing consideration. Pricing is kind of a type of marketing too.
All right, next up, we got a segment that we call Business Blunders. Now, Des, this is not a list that anyone wants to be on, but CJ, you take it away.
Cisco has officially made it back from the 2000 .com crash. So shout out to Cisco. I think we're back.
Yeah, you've been doing Intercom for 14 years. This is 25 years to get back.
Somebody should republish this inflation adjusted and see how far off they actually are. But yeah.
Another one we had, when it's appropriate to sign an NDA. What do you think about this, Des? Like, I'm sure you get asked to sign NDAs all the time or thinking about it. Like, do you make an investor sign an NDA before an initial conversation? Like, how do you think about NDAs?
I'm more on the receiving end of them these days, where startups will approach me and say some version of, hey, we've got a cool idea, but we're wary of talking to you about it without signing a few things. I basically can't sign them because I've invested in probably 150 startups. I talk to probably hundreds more every year, both from a market discovery, some of them are Intercom customers, et cetera, et cetera. I see them all the time. I actually can't kind of firewall my brain. So as a result, I just can't guarantee. Like if someone says to me, like a friend, hey, keep this under QT, but our revenue declined or whatever, yeah, I get that. But it's just generally, hey, I've got this idea, we're going to do AI infrastructure, but here's the thing, it's X, Y, Z. I won't be able to remember that I don't know that. You know what I mean? So like as a result, I really struggle with NDAs in general. I think it's usually to me a sign that somebody believes that their idea is extremely precious. And I think that's genuinely pretty much never been the case as far as I can tell.
Yeah, this founder tweeted, NDAs are a sign you're dealing with A, a giant corporation. I've dealt with that before. They have to sign an NDA for everything. Or B, someone who has no idea what they're doing in business.
The latter is definitely, it's a real tell. It's like, and honestly, versions of this are like, it's not quite an NDA, but when somebody sends you a link to a deal room, you have to provide your email address. I find a lot of that can get kind of exhausting because it's like, I have maybe like 5-10 minutes to spend to give you feedback on your pitch. And if you're going to hit me with all this stuff, it can be quite frustrating, the degree to which you're preloading a distrust in me while also asking for my help,
It's almost never something that's like actually confidential. Like, it's like, oh yeah, we're building an AI company. You're like, okay.
It's almost always a really obvious idea that I can say, you mean like X and Y and Z? And they're like, what are those three? And then you can see the open tree tabs. The next thing their face changes on the call because they're like, I can't believe somebody else thought of AI for generating ad copy or whatever,
Well, it's like to run a 4-minute mile. I know you need to run 4 laps at 60 seconds or less. I know the recipe. Doesn't mean I have the physical ingredients to go out and do it.
Any business blunders grinding your gears, Des?
We kind of covered it earlier in the episode, but it does like frustrate me the degree to which AI startups aren't willing to talk about the value that they deliver and are willing to talk about everything except that fact. Because oftentimes what I find is it's like a chronic misunderstanding of basically what their customers actually want. The other version of that is probably, again, focusing on optics and not on reality. Something that's kicked off, I don't know why, but it seems to be popular again, is like blind introing without any context. Like, so we're in this era of like hot AI deals, as you're all aware, I'm sure, like sales and X, markup, etc. Because of that, I get a lot of like adding Des to the thread. And I'm like, what's the thread? The pitch is always the same. It's like, hey, there's no room in this round. It's actually closed. I don't even want to be on this call with you. But there is a space for a 10 grand check. And you're like, okay, you actually want the money? You're like, no, as I said, we're oversubscribed. I'm sorry. And then eventually, like every now and then, you're like, all right, well, I'll have to think about it. They're like, cool. But also, do you know anyone else who's running 10 grand checks? Because actually, we're looking for 100. It's almost like there's an extremely polished pitch that is obviously getting taught in the incubators or whatever, which is basically go around to everyone telling people that you have the lead investor secured and there's no more space and it's already blowing up and you're already like all your pilot revenue is actually recurring revenue and all that lies that are just so common in this era. Then they try and like solicit a load of angels with like very much exploding deal type options, like as in, hey, it's all closing by Friday. You have to click the link to go to AngelList now or it's going to never be an option. I got burnt by investing in some ropey startups in 2021 under those terms. So I probably have a bit of scar tissue. It might be too much scar tissue. I might actually be losing out on some hot deals here. I don't think I am. It's a real blunder where I'm just like, right, I want nothing to do with this company if that's your MO. So that's probably the one that's frustrating me most lately.
My response is always like, I just don't move that fast. And then what's fascinating is sometimes like, well, it's still worth a conversation. I'm like, wait, I thought you were oversubscribed.
I told you, it's extra comical when you get to ping 3 weeks later being like, and hey, can you not introduce me to John at Stripe?
All right, next up, we have got something that I've tried this week. It could be something fun, something silly, something serious. Kyle, take it away for us.
So we normally talk about, AI tools, startup stuff, but I have a bit of a different one today. We had our first snow of the year in Boston, and like whenever it snows, so I've got a Boston Terrier. He hates the snow. He hates cold weather. He hates the salt on the sidewalk. And I've tried everything imaginable for his paws. Like I've tried paw wax. I've tried things that basically look like dog condoms to put on his paws. Like I've tried everything. And I finally found something that seems to work. They're called walkie paws. So it's like suspender boots. And the brilliant thing is, so you put the like legs in each of these and then you attach them at the top, like on the dog's back. If anyone's looking for a solution to have dog boots that stay on, I can recommend these guys.
Do they take 10K checks?
Exactly.
They're oversubscribed, CJ.
This is marketing in the era of AI. You're a happy customer. This is not an infomercial, but like, look what's happening,
Either of you guys have anything serious?
My serious one, it will not be that shocking to a lot of your users, but under instruction or advice from Fergal, who's our chief AI officer, I played with Claude Code using the latest Opus model. I always have in my head the same 2 or 3 things that I want to see how far it can get quickly. So like if you give me 10 minutes, I try to build a project management app. If you give me like 2 minutes, I try to build a little B2C photo sharing app. I'm always just trying to see like how far can I get and how quickly. The goal is to really just kind of calibrate my own understanding of the terminal decline of SaaS, or this era, sort of rumored era of the death of SaaS. There's like a famous experiment, I think it was called the Nth Day experiment or something like that, where they say basically like, some gang of nuclear physicists were regularly asked to try and build a nuclear bomb to see how much easier it was getting for a new team to do it. Our version of that in the SaaS industry is basically, to what degree is it getting easier and easier and easier to clone Riverside or Gmail or Basecamp or Asana? So I had a substantial, only like maybe a $9 worth of token play with Claude Code and the Opus model. It's getting really good and really scary. That's the one thing I would say. If you're out there thinking vibe coding is where it was 1 year ago, you need to try it again and update your kind of assumptions.
So are you now using the project management app you built?
I'm bearish on the idea that like AI will actually replace your project management app or your email client or any of the internal tools you use, because it's going to end up being a full-time person's job to maintain it, update it, secure it, blah, 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 blah. And then when you look at a full-time engineer's salary and compare it whatever you were spending on Asana or whatever, it's not comparable, right? You don't want bespoke works only for you, works on my machine type consulting work inside your business. However, if you are Asana, or if you are a Fin, or if you are a help desk company or whatever, it's very useful to know how much of your existing tech is hard to copy and how hard. And if you think that that's your moat somehow, you should probably make sure it's a hard to cross moat or whatever.
It's a good place to end things, Des. Thanks for joining us on the pod. For folks listening, you can check out Des's LinkedIn or follow him on X. But yeah, appreciate you joining.
Great to be here.
Mostly Growth is a Mostly Media production. Executive produced by Ben Hillman. That's me. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of CJ, Kyle, and Ben. Just some guys who love talking growth. Mostly. If you like this podcast, hit subscribe. Give us 5 stars or hit like. The algorithm overlords thank you. Drink water, call your mom, and have a great day.